Hey everybody, it's Bobby Ichino, and I wanted to make a quick video because something interesting happened on Monday, June 3rd in the context of U.S. economic data. There's a piece of data called the Institute of Supply Managers Purchasing Managers Index. Okay, and it's a survey of very large businesses, and they talk to the purchasing managers to see what's going on with prices, new orders, whether they see their business growing, shrinking. The numbers range from, let's just say for the sake of this conversation, from 40 to 60. They can go higher and they can go lower, but they generally don't. Anything above 50 is considered an economy that's expanding, and anything below 50 is considered an economy that's contracting. So this Institute of Supply Managers Index has several different components to it. It's got a price component, it's got a sentiment component, it also has a new orders component. Now, the headline component was below 50. This is the manufacturing version of this particular index. Okay, that was below 50. That was contracting. And it was actually lower than expected and lower than the previous month. It was supposed to be higher than the previous month. That's what the markets expected. But one key part was the new orders part, which not only was lower than the previous month and lower than what was expected, but it was down at 45 and change. That's a very, very soft number, meaning U.S. manufacturers are getting not only fewer orders, but the orders are declining at a faster rate than they were the previous month. When you add to that consumer prices have gone up month over month, 3 consecutive months now, meaning inflation may be ramping up again. We start to talk a little bit about stagflation, which I've talked about before. We start to talk about the concern with the possibility of raising taxes, which I've talked about before. And there's one more component of this really ugly trinity that I haven't talked about yet. That's the $1 trillion every 100 days that the US government is now adding to our national debt. As it sits right now as I talk to you, every taxpayer in the US owes over $266,000 to pay the national debt. That's how much, if we were to pay it off as a populace, each person that pays taxes would owe $266,000. So what does this mean? Well, if the economy is slowing and inflation is going up, again, as I've talked about before, the Fed is in a situation, that's the US Federal Reserve, as to if they raise interest rates to try and curb inflation, they're going to sink the economy. And if they cut interest rates in order to try and help the economy fire up a little bit more, they're likely to boost inflation. All of this hurts the consumer. So what are they going to do? They're likely to start buying their own treasuries again. The last couple of treasury auctions, as we all know, the US government issues bonds. That's the debt we're talking about. The last few auctions went very poorly. There weren't a lot of people buying them. So that means that the likelihood of the US Fed coming in to start buying them again is going up. And what is that in real world terms? That's printing money. And when you print money, what benefits? Precious metals, gold, silver, industrial metals, copper, aluminum, even things like uranium and platinum. They all benefit. But the two that really benefit are gold and silver. And we've seen that in the price action lately, and we've seen it in the price action long term. This is not a problem that the Fed can just snap their fingers and fix. It's not. That's why I tell people, not only do you want to get into precious metals, but you want to actually hold them in your hands. So call Golden Crest Metals and get a consultation. See if this is the right place for you. They got very low spreads and they have very good products and they have a very good support team and sales team. This is a good company. This is a good thing for you to have in your portfolio. I'm Bob Ichino. If you have any questions, reach out to me any way you can. I'm out there. You can always find me.